Hello. Today we wanted to answer this question. Do central banks coordinate their actions? We will start by quickly analyzing the FOMC and the ECB press conferences of December 2022. Any similarities in the speeches should be purely coincidence.
Good afternoon and welcome to our press conference.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal.
To ensure a timely return of inflation to our 2% medium-term target.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point.
The Governing Council today decided to raise the three key ECB interest rates by 50 basis points.
Ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to our 2% medium-term target.
In addition, we're continuing the process of significantly reducing the size of our balance sheet.
The asset purchase program portfolio will decline at a measured and predictable pace.
Restoring price stability will likely require maintaining a restrictive policy stance for some time.
Keeping interest rates at restrictive levels will over time reduce inflation by dampening demand.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored.
And will also guard against the risk of a persistent upward shift in inflation expectations.
Despite elevated inflation, longer-term inflation expectations appear to remain well anchored.
Over the medium term, though, risks stem primarily from domestic factors such as a persistent rise in inflation expectations above our target or higher than anticipated wage rises. We expect to raise them further. Comparisons are odious, but if you were to compare with the Fed, we have more ground to cover. We have longer to go. Our future policy rate decisions will continue to be data dependent and follow a meeting-by-meeting approach. I know that it is tempting to assume that, oh well, all central banks are doing the same thing at the same time. Not quite. The ECB is not pivoting.
All right, Madame Lagarde. We got your point. Now, let's see what Jerome Powell said about central bank meetings at the Bank of International Settlements, the BIS, in a recent interview with David Rubenstein on Bloomberg Television.
How do you coordinate with central banks, let's say in England or Japan or China? Do you have regular conversations with them about what they're doing?
We do, and I meet 6 times a year in Switzerland with the heads of many central banks, even the small and medium-sized ones in Basel at the Bank for International Settlements. In addition, among the major central banks, I have regular dialogues going with most of them, and so what we're talking though about is really what's happening in the economy and how are you thinking about policy and that kind of thing. It's very important that we keep those discussions going because, particularly in a crisis, you're going to need to know each other and you're going to be able to trust each other.
And do you think the U.S. economy is pretty much in control of its own inflation rate, or are there events outside the United States like what China is doing or the Ukraine war that are affecting inflation and make you nervous about where inflation might be going?
We have the tools, the Fed has the tools to achieve our 2% goal over time. But inflation in the United States is, of course, very closely related to things that happen here, including the balance between supply and demand. It's also affected by, for example, commodity prices that are really set on the global markets. Oil and many agricultural commodities are priced globally. So there are certainly, it's an integrated global economy and global markets.
I know that it is tempting to assume that, oh, well, all central banks are doing the same thing at the same time. Not quite.
I meet 6 times a year in Switzerland with the heads of of many central banks, even the small and medium-sized ones.
Our verdict is that central banks may not do exactly the same thing, at exactly the same time, but obviously they coordinate their policies, because the world monetary system is interconnected, and the global markets interact in various ways. For instance, after COVID-19 hit, central banks coordinated a monetary stimulus to avoid a deep worldwide recession. The current high consumer price inflation environment originated in a combination of factors, namely supply chain disruption, the energy crisis due to sanctions imposed on Russia, and the excessive stimulus since 2020. An environment of low interest rates makes it possible for non-profitable companies to subsist, by accumulating more cheap debt. But now, with interest rate increases, this does not hold anymore, because the cost of servicing new debt is largely increased. Thus, the stress on the economy increases, with companies laying off people and reducing costs, trying to keep their profit margins. Finally, the risk of defaults and bankruptcies is higher. Now, central banks are trying to tame inflation essentially by destroying jobs and reducing demand. Central banks cannot stimulate production, so they try to reduce demand. History shows that this process can be painful and can lead to recession. However, have you noticed that central banks talk about a 2% inflation target? Why is that? By definition, price stability should mean that prices don't change. If prices don't change, the inflation rate should be 0%, not 2%. Why do we need 2% inflation? Because most governments are highly indebted, and need an environment of negative real bond yields to be able to sustain their debt. The real yield of a bond is the nominal yield minus the inflation rate. Negative real yields means that the yield on a bond is lower than inflation. However, inflation is not calculated using the same basket of products over time. Some argue that if CPI was calculated the way they did it decades ago, the inflation value would come much higher, which means the real yields are lower than the official numbers lead to believe. These days, with inflation running close to 10%, even if a bond has a 5% yield, you are guaranteed a loss of approximately 5% a year. By having a little bit of inflation, let's say 2%, together with low bond yields, helps to manage the debt burden without increasing the interest paid on that debt. The big problem is the following: when nobody wants to buy bonds, or if they start selling their bonds in the open market, then what happens? Bond yields increase dramatically. The solution? Central banks come into play, and with the help of commercial banks, eventually buy these bonds, monetizing government debt, lowering yields, and keeping an illusion of stability. Now, the Fed and the ECB are trying to reduce their balance sheet, the so-called quantitative tightening. Let's hear what an expert has to say about this.
But Japan, unlike a lot of Western countries, has a folk memory of what can go wrong when monetary policy spins out of control. It's a bit like the Germans today, who still recall what happened with hyperinflation. And so there is a certain degree of nervousness inside Japan about the way policy's been going. So don't rule out a policy shift, and don't ignore the fact that that could impact global markets.
Julian, let me add one other potential complication, and that's the debt ceiling crisis. It's probably not too strong a word to say crisis looming in the United States, you know so well. There's been a lot of concern about what the Fed might be doing with liquidity here because of the debt crisis really comes on us this summer. We're going to have some challenges. How does that play against the liquidity issue? Well,
that's a critical issue, and in fact, I wrote a column about that recently, pointing out that there's never a great moment to have a debt crisis, but it's a particularly bad moment when you are embarked on this astonishing monetary policy experiment called quantitative tightening, or attempted quantitative tightening, because the scale of what the Fed is trying to do in terms of shrinking the balance sheet, leaving aside the issue of what the Bank of Japan is doing, the scale of what the Fed's doing is really very significant. And one of the things that concerns me is that we know the Treasuries market is actually quite fragile in terms of its underlying structure. The reason's a bit complex and too complex to go into, but it's to do with the fact that you don't really have market makers in the system anymore, keeping markets stable in a crunch. We saw what that means in March 2020, during the early days of COVID, when the Treasury markets came really close to seizing up completely. We've had other mini flash crashes and worrying periods as well. And if we have a debt ceiling crisis, coupled with the fact that essentially the Fed is trying to stop buying government bonds and we don't yet know who's going to buy them instead, you've got the makings of, if not a new crisis, then certainly a lot of risks.
Thank you so much to Gillian Tett.
What matters for the common mortal is not necessarily the details of these bond market operations. What matters is that any savings done in fiat currency are continuously losing purchasing power due to consumer price inflation. Currency can be put to work in a variety of investments, participation in businesses, or hard assets, such as real estate and precious metals. But to invest, you should first learn about the different possibilities, and start small. Good luck! If you enjoyed this video, don't forget to like and subscribe to this channel. The content of this video is for information and education purposes only. The viewer is advised to verify the information using the cited sources.